Let's now look at what are the reliefs which are available in respect of restructuring of the operations or on transfer of certain assets. So first, let's look at transfer of assets and liabilities. Now, let's say, for example, if there is a transfer of assets and liabilities between UAE resident companies that are at least 75% commonly owned. So, for example, if there are two companies, company 2 and company 1, let's say there is a person X who commonly owns 80% of this company and let's say 90% of this company. So both these companies are commonly owned for greater than 75%. In such a case, the transfer of assets and liabilities between company 1 and company 2 or vice versa, which is transfer of assets and liabilities from company 2 to company 1, will not be liable to corporate tax. So in such a case, what is going to happen is it is deemed that the transfer has been done at tax net book value. So let's say if an asset had a cost of acquisition of 100, there was a tax depreciation of 30 which was claimed on it. The tax written down book value of this asset will be 70. It is assumed that the transfer is done from company 1 to company 2 at 70, so that now company 2 can claim depreciation on this asset at a value of 70. Because the transfer is happening at the book value, there is no capital gains as such on company 1. However, for this tax neutrality to be in place, the condition is that the assets and the liabilities transferred by the company, let's say if transfer is company 1, should remain with the same group with a minimum period of 3 years. So let's say if the transfer happens on 1st of January 2024, then the assets should remain with the group until 31/12/2026. 3 years, 24, 25 and 26. If they do not remain as such and the assets are thereafter transferred to someone else outside the group, then whatever gains were exempt earlier are going to be taxable. They will be recalculated and they will be taxable in the hands of the transferor in the year when these assets are transferred to a third party. So under the proposed law, there is a provision for providing relief from UAE corporate tax in case there is a transfer of business and there are certain conditions which are satisfied. Now, globally, what can happen is that various companies may have different set of businesses within their group companies. Now, sometimes due to business requirements, sometimes due to some other commercial considerations, they may actually consolidate their businesses in different entities into a single entity. So if I just look at the pictures on my left, here what is happening is there is a parent company and that parent company owns 100% of UAE company 2 and 99.99% of UAE company 1. Now, commercially, if this company feels that, why have two entities? We'll need to do the audit separately. Maybe we need to form the tax group. If we don't, then we need to file the tax return separately and so on. So they may feel that instead of having two companies, let's have only one company. And this generally can be achieved either through the process of merger, something which is also called a spin-off or transfer of business. To ensure that such transfers do not attract tax, the draft PCD provides that the proposed law will either exempt or allow for a deferral of taxation where a whole or independent part, which means, let's say if this company was carrying the business of manufacturing and trading. So one is if it transfers both the business, but the other thing can be it can only transfer one of the businesses while continue with the other one. So either there's a transfer of whole business or there is a transfer of independent part of a business are transferred in exchange for shares or other ownership interest. So when there is a transfer that is happening and in lieu of this transfer, what the transferee or the acquirer company gives is shares or other forms of ownership interest, Other forms of ownership interest may arise, let's say if the transfer was done to a partnership firm and the partnership firm gave a part of its ownership to this particular parent. In such a case, this transfer will be exempt from, or if there is any tax which is payable, that will be deferred for future periods. The second important point here is that the transfer will be deemed to have happened at tax net book value. So what this is going to do is, let's say if there is an asset worth 1 million dirham in the books of transferor with a tax value of 500,000 dirhams, the transfer will take place at 500,000 dirhams only, deemed to have been taken at this, and therefore the taxable gains will be nil. The third important point is that once this transfer is done, then basically the business should remain within the same group for a minimum period of 3 years. So let's say if the transfer is done in a particular year, X, then the business should remain with the UAE company for X plus 3. If the transferee does not keep the business for 3 years, then the year when the business is further transferred, in that year, one will calculate what were the capital gains which were exempted at the time of transfer, and the tax will be payable in such year. Now, let's look at an example where an individual is carrying out certain business, and this business is carried out as a sole proprietorship, and he wants to convert it to a company. Now, in many cases, what can happen is that the individual for their businesses have unlimited liability. In addition to this, if the individual really wants to expand the business and for such expansion wants to do tie-ups or fundraise or for other such things, they may want to convert this business from an individual driven business to a corporate business. In such a case, the question that comes up is that would the capital gains or arising on the transfer or such conversion would be liable to corporate tax? So factually, if an individual carries on business, he contributes the business to a new company. So the entire business is transferred to a new company. And in lieu of such transfer, the individual gets shares in the new entity. So this new company will issue shares to the individual. The transfer for this purpose is again deemed to be at tax net book value, just like what we discussed a bit earlier, right? So if these conditions are met, then this conversion will be exempt from taxation. However, just like we saw in the preceding slide, the condition is that the business should remain with the new company for a minimum period of 3 years. If the business is transferred by the new company within a period of 3 years, then in the year of transfer, the capital gains which were exempted earlier may be liable to taxation. Thanks for watching this video on UAE Corporate Tax. If you want to get more such videos with a lot of practical insights that will help you deal with the UAE Corporate Tax, you can subscribe to our course, whose link is given in the description below. We will be discussing various developments that happen in the UAE Corporate Tax in this particular course, as well as for the next 12 months. And whatever questions you have, we will be conducting live sessions for queries, etc. for the registered users. So in case that is something for interest for you, do join us at the link given in the description below.